On the Spot with Michelle Makori is brought to you by Meld, the next generation decentralized global bank.
Hello, I'm Michelle Makori. Thank you for joining us. We are still in somewhat of a macro fog with mixed indicators about the health of the U.S. economy. Inflation is easing, but still increasing, just at a slower pace. Headline CPI for July rose 3.2% year over year. Now, that was higher than the 3% reading seen in June, as well as the first uptick in prices in 13 months. But it was lower than the 3.3% expected. And the Producer Price Index, which tracks the price that businesses pay for raw goods, services, and materials, came in higher than expected, rising 0.3% from the previous month to 0.8%. Meanwhile, with the second quarter reporting season nearly complete, 79% of S&P 500 companies have posted earnings that beat analysts' expectations. While bottom lines looked okay due to cost cutting, increases in revenue were not that impressive. And the state of the banking sector is still very much a concern. Moody's has cut the credit ratings of 10 mid-sized and small U.S. banks. And Moody's is also warning that it could downgrade some of the nation's biggest lenders like Bank of New York Mellon, U.S. Bancorp, and State Street. And we got a much more dramatic credit downgrade recently, with Fitch cutting the creditworthiness of the U.S. from AAA to AA+. So let's get some analysis on the state of the U.S. economy, what we can expect from the Fed, and the big geopolitical threats that are largely being ignored by the markets with Peter Grandich. Peter Grandich specializes in retirement business and estate planning. He has 4 decades of experience in the financial markets. He's written several books, including Confessions of a Wall Street Whiz Kid, and is the founder of petergrandich.com. Good to have you back with us, Peter.
My pleasure, Michelle, truly.
All right, so Peter, let's start off with the July inflation numbers here. So on the CPI front, we did have the year-over-year number of 3.2% versus the expected 3.3%. Core CPI, which excludes volatile food and energy costs, that rose 4.7% year-over-year, but it was lower than the 4.8% expected. Now, it's interesting to me, Peter, that many analysts are saying that this is good news because these numbers came in better than expected, but dismissing the fact that still higher in June and still well over the high inflation numbers from last year. Meanwhile, we had the Producer Price Inflation Index coming in at 0.8% year over year. That was higher than the 0.7% expected. So broadly speaking, what is your read on the latest batch of inflation data?
Well, anything is better than near double-digit inflation, which wasn't too long ago. But I think to think that it's just going to go away and not impact people, especially people in the working class, because wages still are underperforming the rate of inflation. And so long as wages rise less than whatever the inflation rate is, more and more people are going to struggle to pay for daily prices. So, I know everybody thinks it's happy days are here again to some extent on Wall Street, but these numbers still have sniffs of potentially staying around and lingering a lot longer than expected, especially since oil now has recovered dramatically and is back near almost to a yearly high. And we have to always remember that oil plays such a role in cost of products. And I think the other thing that people aren't talking about is the potential for oil to go a lot higher because of what Saudi is doing geopolitically regarding BRIC nations and a potential move away from something that's been since the 70s, an automatic necessity of using dollars for oil. And if that is to change, which we may learn in a few weeks, that would have major ramifications. But right now, the fact that we've come down a lot is giving what I like to call the don't worry, be happy crowd on Wall Street ammunition to say, listen, things are going to get a lot better. I'm not in that camp, but I can understand them why they're saying that.
Yeah, the don't worry, be happy crowd. Well, Peter, you touched on a very, very interesting point, and that is the oil component of all of this inflation data. And that we may get a very, very nasty surprise with certain developments coming out of this BRICS meeting that is happening August 22nd in Johannesburg, South Africa, with some speculation that the Saudis may join BRICS and they may pull out a very big move and maybe even at this point move away from the petrodollar, pricing oil in dollars, which, as you touched on, was an agreement reached between the Nixon administration and the Saudis back in the 1970s. Is that something you're expecting to come out of this BRICS summit, a big Saudi announcement and perhaps an official move away from the petrodollar?
I don't think at this announcement, Michelle. I think this announcement is more going to be that there's going to be more clarity to what the BRIC nations are hoping to do and also increase its membership. What I don't think Wall Street has paid any real attention to, and will come back to bite them, is the shift for Saudi Arabia and the Middle East in general more away from the states and the dollar and to other people that aren't exactly friends of ours, China, Iran, and things of that nature. And I don't think they understand when you hear Saudi principals talking about willing to sell oil in other currencies other than the dollar, how historically that would be and what that would mean. And I would suggest that 9 out of 10 financial advisors have no idea what that could mean. But it is something I think that's going to be moved to. And I think at the same time, we had a president here that drew down our strategic reserves to levels of dangerous levels at a time when it's clear that we don't have the same rapport or relations in the Middle East that we might have had 10 or 20 years ago.
Right. And I definitely want to unpack the conversation around de-dollarization much further. And we'll do that in the second part of this interview, Peter, because geopolitical issues certainly a big concern here. And you're quite right. Most of Wall Street is probably dismissing the bigger picture and looking at the near term. And as you say, going into the don't worry, be happy crowd. But just to play along with one of the issues that you raised, when the Saudis, if the Saudis do officially drop the petrodollar, and we're already seeing oil being traded in other currencies with India paying for oil in rubles and the United Emirates currency as well. And we're also seeing trade between China and Saudi Arabia using the yuan, but sort of still backed to some kind of gold system there. If the Saudis do actually abandon the petrodollar, what would that mean for the price of oil and for inflation?
It really changes the whole world scheme of things. People still have to recognize that it's all great to talk about green energy and what life is going to be 10 or 20 years from now. But the here and now is still the world runs on fossil fuels. And so that would have an enormous impact. My personal feeling, just so you know, is while the August meeting is not going to be the earth shattering, I believe within the next 1 to 3 years, the BRIC and what is happening with BRIC nations is going to rival the Industrial Revolution, because I don't think people understand how many people and countries are moving away from working with the United States in any type of trade or using its dollar. And if for any reason we ever lose the dollar as a world reserve currency, it's been one of the reasons we've been getting away with the type of debt crisis that we've allowed to happen. And if that changes, some of the more doom and gloomers who I never felt I was in that camp, I think they would need to start being listened to at that point. But I don't think that's happening in August, but I think it's something coming down not in the too distant future.
How not too distant future?
I think you have to think in pattern of months. I think this is going to gain, I think the BRIC nation stuff is going to gain legs once we see the additions of these countries coming involved, especially with basically using this bank in Shanghai and really just moving away from the U.S. system. When we weaponized against Russia, we made all our countries, including so-called allies, go, hey, wait a minute. If they did it to them, what's to say they can't do it to us? And I think there's going to be a much faster track movement for these countries to at least bilaterally trade and skip the United States and skip the dollar. Whether or not they're going to introduce a new currency to compete or whatever, but I think they're clearly moving away from the United States, at a time when economically we need to be doing more trade in the world, not less trade.
Well, they've made it very clear, Peter. They have said that their agenda is to dump the dollar and to trade using their own currencies. We have heard that from the leaders of China and Brazil and Russia, and even confirmation from the South African ambassador that this meeting's agenda may not include discussing this gold-backed common currency that people were speculating we would hear about, but certainly deepening the whole idea of trading amongst themselves using their own currencies. But we will circle back to the whole BRICS agenda and again, what it means for China and in light of China's economy. So clearly a lot of big issues on the horizon in the longer term, but let's bring it back to the near term, Pete. And the big question is, what does this latest inflation print mean for the Fed, considering we are at the highest level of rates in 22 years at 5.25 to 5.5%. And according to the CME Fed Watch tool, markets are expecting the Fed to hold rates steady in September. Over 88% is the expectation there. What are you expecting for this upcoming meeting?
Well, I think they're going to have a new ammunition, and that's going to be the continuing revising past payroll numbers. Some have talked about it. I've been talking about it since early this year. And they finally came out and redid every single month this year lower, because the birth rate model has really been put out of whack by them. It's a model that they only know the makeup of it is, and they just take numbers and say, we anticipated that X amount of jobs were created. And it's really kind of helped markets because it came in better than expected. Everybody jumped for joy. And then next month they said, well, we take it back. It wasn't as strong last month, but by then it already had the impact. And then the next month they did the same thing. So I think the Fed is going to see more room in terms of employment concerns. Where I don't think they're going to get as much is that people need to recognize that with much higher oil prices, how that impacts daily costs, and the fact that people's wages are still not keeping up with whatever the inflation rate is, which makes it more struggling for people. So I think a recession is in the cards. Soft landing or hard landing at this point is still up in the air, but I think the Fed is going to have more room to operate in the second half of this year than they did in the first half.
All right, a recession is in the cards and more room to operate. By more room to operate, what do you mean by that? Are you expecting a cut?
No, what I mean is that they will not. It was mandatory for them to be raising during the first half. The inflation was just out of control.
Okay.
We may have reasons to say that we can at least pause at this point in time.
All right.
Where we will have the problem is if this continues this way into 2024, then the added pressure is they have to think politically, are their actions impacting the presidential race? That always becomes a concern in the president race, but we're still several months away from that.
Right. Well, the Fed is supposed to be an apolitical organization, as you know, and should not be taking these kind of factors into the equation, but what things should be and what things are not. Always the same thing, Peter. All right, so you're expecting the Fed to hold steady for the rest of the year. You're not seeing another increase for 2023, but you're potentially seeing a pivot in 2024. Is that correct?
A pivot in that they will just stop raising rates and basically say we're done. I don't think they're going to get to the point where they're going to actually start cutting rates until they would have at least a quarter of clear declining economic numbers. And I think that's where Wall Street is making its mistake. It got so used to the Fed always just putting the pedal to the metal, and it would always help the equity market. And they've been wrong for a couple of years that they would be helpful. And I think they're going to be wrong that they're going to be helpful in the next 12 months as well.
Right. Well, I don't know. I think the markets are kind of getting used to the fact that we're having a Fed that continues to be aggressive. And surprisingly, we haven't seen the markets react negatively to that. And that has been a big surprise because we did expect a big sell-off going into this year. You said a recession is on the cards. Markets were expecting a recession in the first half of this year, and it didn't happen. Meanwhile, the odds of a recession are falling. Goldman Sachs, for example, has trimmed the estimated probability of a U.S. recession over the next 12 months to 20% from 25%. As for a recession this year, JP Morgan does not see a recession at all in the third quarter. And Bank of America also throwing in the towel on its recession call, telling clients that recent incoming data has made us reassess the forecast. And Bank of America now seeing growth this year at 2%, following by 0.7% in 2024. So you're still saying you see a recession on the cards, though?
Well, first of all, I take pride as a contrarian to know that they're all going in the opposite direction of me. So I'm not upset about that at all. And I have not been one that have been calling for a recession, but I do think now we're seeing a lot of negativity in the 80% of earners in America. It's more challenging now than any other time in recent history for the average American to move forward. And without them moving forward and in fact, falling backwards, and combining that with other things happening around the world, including in China, which suddenly has put itself on the face of, are they the next downfall, domino type Japan country? That in turn is going to make things weak enough that we'll have at least a shallow recession, not a hardcore one. But a recession is a recession no matter how you look at it.
Okay, definitely want to circle back on China and its economic prospects. But when do you expect this recession then?
I've always said that it was going to be in 2024. So put me down for first quarter, second quarter, and then we'll go from there.
Okay, you're down for a recession first and second quarter of 2024. So you're not necessarily out of line with a lot of the big analysts, as much as you like being a contrarian, because they are projecting for 2024, but they've kind of ruled out a recession in 2023. But what was interesting, Peter, is that going into 2023, so many people were saying that we were going to see a recession, that we were going to see markets crash. And we got the opposite. First quarter GDP came in at 2%, second quarter GDP 2.4%, the S&P 500 up 17% year to date, the NASDAQ up around 31% year to date. So how did so many people get this so wrong going into 2023? Wrong about the recession, wrong about the economy, and wrong about the markets?
Michelle, my biggest argument is a simplistic one and make people think it was too silly to be an argument. But I believe we have a whole generation of financial advisors that have been raised on a one-way street. The vast majority of financial advisors right now have basically been in the business 20 years or less, and almost half 10 years or less. And they really got used to, you have a pullback, you always buy it, and it goes up. So when we had such a substantial decline last year, and knowing that there was still ample liquidity in the markets, it's no surprise that they took advantage of a sharp decline. That is what they've grown used to. That's how they know how to drive a car. The question will be, is what I argue is that when things slow down, and we don't have rapid market swings in one way or another, how will they be able to learn to drive now on a two-way street? And that's where I still think the unknown's going to be. And that's only going to be seen when we finally have this recession, mild or whatever you want to call it. And they don't have the earnings and the liquidity being provided by the Fed, and new issues that almost none of them have any experience in, and that's geopolitics. You've been around, Michelle. I know in the work you've done, geopolitics has been basically removed from investment equations for a decade or more. Now it's being put back in a very hard matter with the BRICS, with the politics of both abroad and what's happening here in politics. And of course, now the latest thing that's come now is what is happening in China. Many of us who just a few months ago, and I was one of them, was expecting China to come back strong, and that was going to help our commodity predictions and all. Now, in these last few weeks, we are seeing numbers, and again, hard to, because China's not exactly the greatest place to count on honest data. But nevertheless, we're seeing issues of real concern now, and where China goes is where the world economy is going to go. So that's the new fly in the soup, so to speak, right now at this point in time in my outlook.
Okay, again, we're going to go back to China and unpack that. And you're quite right, Peter, for the most part, bigger geopolitical trends have been dismissed, ignored, not really been a factor. And you can see that not only in equity markets, but also in the gold market, much to a lot of gold people's frustrations there. But let's focus on what you see in terms of the equity markets right now. Do you think that there's more juice left? Do you think that there's more upside left in equity markets right now, given what you said about the mentality of markets and financial advisors?
We've seen some statistics come out now, even some of the more bullish forecasters, that boomers, people of my age, who really need to start to be more conservative, are still too much overweighted in equities. And many of them a year ago, when they suddenly saw their retirement accounts down 25 or 30%, had something far worse than financial anguish. It's called mental anguish. And finances should never cause mental anguish. But the fact that we've had this rally, something that I've actually hoped for those people who are still too far much exposed, is that any further rise in this, I really think is a reason to become a seller, not a buyer. It's very hard to justify a market first buying it today. One of the biggest complaints I heard over 40 years, Michelle, from investors was, hey, you guys on Wall Street, you always tell us when to buy, but you never tell us when to sell, or you don't tell us the right time to sell. And my response always is, stop where you owned it. Can you put the same amount of money in today firsthand into what you have now? And when people hesitate and hold and go like this, I go, well, wait a minute, maybe that's a cause of concern. And that's where I think the stock market is right now. I wouldn't begin to start a general equity portfolio at this point. And if I wouldn't, and I owned a lot of it, then I would look to come out of some of that holding.
Okay, so should I read that as you do not see significant upside left in the equity markets right now?
If you want to call 5 or 10% significant, then yes, I guess that is. I mean, there's still enough optimism, over optimism, to push it to a bare new high. The problem is there's fewer and fewer companies participating in this. So even if we manage to get over that line and create a new high right now, it'd be a very technical divergence negative, and we probably have a sharper sell-off this time around than we did last time. So actually, if it pauses here and moves sideways, it's actually better off, if you're optimist, than still go up higher here with less and less companies participating in this rise.
Okay, so sideways trading would actually be a positive, but what is the likely, do you think?
Well, those of us who live by a crystal ball, we only learn to eat a lot of broken glass, Michelle. So I have no real idea. I can give you an educated guess. I think there's going to grow more of a concern here, both politically, what's happening here, and what's happening with the BRIC nations. I think people are going to realize after we learn more after August, when this announcement comes out, how much things are changing in the world and how much the United States is not going to be a player in it. And I think even the don't worry, be happy crowd are going to have to start rethinking earnings out for the next few years as the United States becomes less of an economic power in the world.
You know, it's so interesting, Peter. We talk about this BRICS summit a lot on Kitco News, but it gets barely mentioned on what we call the traditional mainstream media. Barely mentioned, not even brought up at all. And we've had a lot of analysts on this show, including yourself, that say this could be such a significant game changer. And as you quite rightly pointed out, geopolitics not really on the register of many market participants. And, you know, one then has to wonder, a lot of markets is about sentiment. It's about feelings more so than facts. Sometimes you see that happening in the market. So if they continue to dismiss geopolitical threats, that does build the case for continued upside, at least in the short term.
No question about that. But if there's still people, listen, Michelle, when I started investing, every research report had a 3 to 5 year outlook. If you talk to investors now, I think this company or whatever, this index, whatever, can do real well over 3 to 5 years. They'll look at you and go, 3 to 5 years, maybe I'll wait 3 or 5 months. So if you're going to be short-sighted this year, I guess if you're just interested in the next few months. But if there's anybody investing for the next few years, I think the things that are happening now, geopolitically and economically and socially, you know, dramatic changes on the social front. Listen, this will open a whole new can of worms, and I know we don't need to discuss, but I call lawlessness now in America a growth industry. I mean, there are just so many things happening that aren't getting the proper coverage. And by the way, that's why people should watch Kitco and not the main news stream, because you at least are talking about things that people need to hear about. And that's why I think the surprises are going to come. And markets hate surprises. And that's why I think for 2024, it's going to be a tougher year than 2023 was.
Yeah, I mean, lawlessness as a growth industry. Elaborate on what you mean by that.
Well, the internet might make it seem more sometimes, but we're seeing now where in major cities all around the country where people are just taking things that don't belong to them and doing it with little or no regard, and having people in charge saying it's okay, don't let them go. And people have grown very concerned. There are a lot of people that will tell you, I know you're in New York City, but walk around or look around New York City and tell me you feel as safe as you could have felt 10 or 20 years ago, then I, as someone that was born and raised there, I would have a tough time. And I think we can show that in many major cities. And that has roles too. That's one of the reasons why commercial real estate is having difficulty in office buildings. And then the states have the city has less revenue. They have to cut services, and it becomes a vicious cycle. And all these things are just kicking in now. The key is to see the perception of it and get out before it happens, because once it happens, it's too late to react to it.
No, you're so right, Peter. I mean, and this lawlessness also impacts prices, because you have producers having to make up for the fact, and retailers having to make up for the fact that they're losing so much in theft. I mean, right now, in many democratic cities, if somebody steals something under $1,000, there's just absolutely no legal ramification for that. And you're seeing so much of this uptick in crime, which impacts stores, which impacts retailers, which then also gets trickled down to the consumer. And here in New York, I absolutely do not feel as safe as I used to. And just popping into the CVS 2 blocks down from me, everything is behind a plastic shield, right? You have to summon an assistant to unlock things because the theft is so rampant. I tried to get some ice cream the other day, Peter. The fridge is locked. You have to get someone to open up the fridge at the CVS in order to access the ice cream. Maybe not such a bad thing, makes you reconsider if you really do want that ice cream. But this is the scenario that crime is so rampant that everything is locked in stores. And as you said, that does impact commercial real estate. Those costs are then trickled down to consumers who have to make up for the profit loss because, you know, of the sticky finger situation. And it is certainly a big issue, as well as some of the other political issues and socio-economic issues that you've highlighted in your top 10 things to watch out for report, which we are definitely going to have you back to talk about in length and something to look at now. But let's go back to the geopolitical front, because you have touched on China quite a bit. And we did get some interesting data from China. We saw, for one, that China's exports saw the biggest drop in 3 years last month because of weaker global demand. Exports were down 14.5% in July compared to a year ago. Imports also falling 12.4%. That is not great data at all. China's also experiencing deflation. Its consumer prices declined for the first time since early 2021, following 0.3% year-on-year in July. And in terms of GDP, I mean, we always take the GDP data from China with a very big grain of salt. But what we are getting is that the economy grew 4.5% in the first quarter and 6.3% in the second quarter on a year-on-year basis. So you've said before that you're on the fence regarding China. Do you have more clarity now?
Well, it's certainly moving to the negative side of the fence, not yet ready to fall off, because they still could make some dramatic monetary changes that can change that. The hidden concern, what I'm deeply concerned about is, you know, governments, like when people start to suffer, they like to take their minds off it. And one of the ways governments take minds off it is getting themselves involved in wars or battles and expressing to people, listen, these people are bad and they're going to hurt us, so we need to go do this. This could actually expedite whatever their long-term plans was regarding Taiwan. And that would be another geopolitical firestorm that I don't think the United States is even close to handle, and so forth and so on. And one of the things you need to know, and this goes because I've had a very long-term friend who's was very high up in Chinese business, and he'll tell you that one thing Chinese people will speak about is they feel Taiwan should be part of China. If you talk to people that are in China, not obviously people in Taiwan. So they would be all for something that moves for that happening. What way to take off the problems that they're having and not doing so well than suddenly having that happen there. And of course, they can control the media on how it's reported and all. So I hate to say that that's something that's going to happen, but it is something that can be a ramification if the economy continues to worsen in China, which is still up in the air. You still noted some fairly good GDP numbers, again, questionable, but they're having some really, really deflationary winds now, especially in the real estate market. And so it's going to be really important. Whatever happens there in the next 30, 60, maybe 90 days can have dramatic impacts on all of us for 2024 and beyond.
Right. Well, let's discuss this distraction by attacking Taiwan a bit further. I get that it's often a tool implemented in order to distract and take the focus off domestic issues. And we have seen tensions escalating with regards to China, Taiwan, and the US. But how likely do you see some kind of action against Taiwan being taken, and over what time frame?
Well, from everybody that I follow and the Gordon Changs of the world who have demonstrated to have real knowledge when it comes to China is it's only a question of when, not if. Would they like to do it in a more peaceful manner than have to have a full outside war? Yes, I believe so. But there's no question that they feel that that's necessary to part of where they believe China should be on the world. And let's understand now also, China has become more acceptable to more countries than they might have been 10 or 20 years ago. They even, if whoever imagined they would even be doing something in cohorts with Russia, something that was unimaginable 20 or 30 years ago. So that's geopolitics where Wall Street does not really still pay any attention to, and certainly the average typical financial advisor doesn't. But those are the things that can suddenly happen overnight and change everything. And I don't think people have a plan B. I think they just have a plan A, that we put our foot to the metal, we buy stocks, and it always works. And that might have been the case, but things have changed dramatically. This, if I may just say, the way the market works versus when I entered the business 40 years ago, there's nothing in common anymore. It's a highly sophisticated, machine-driven investment way that people really, half the people are invested in funds that aren't actively managed. Then the other half, 80 or 90%, are in some sort of computer-driven program that's deciding whether through wording or algorithms or what have you. People no longer buy a stock to be part owner of a business of a company anymore. So all those things all have not been thought out, and what can transpire if the key parts of support start to break away. And those are economic, political, and social issues. And all those three are going in the wrong direction, in my opinion, as an American, for America.
Yeah, you certainly raised some very, very, very valid points there. And so much investing is done off sentiment, not even looking at fundamentals so much of companies anymore if we look at price to earnings ratio. But let's talk about this idea of China becoming weaker, because if it is suffering on the domestic front with regards to its economy and its exports and imports, does that diminish its role in the BRICS? Does that in a way dilute the impact of what we can expect from the BRICS as a rising force?
No, I think one of their points is by being more involved in these countries now, being a player in the Middle East, and whoever expected that you see the Chinese leader in the Middle East helping to try to make peace. I mean, no one could have imagined that 10 years ago, even 5 years ago. I think what they're going to do is, I think the BRIC situation is going to actually help them, because they're going to be doing more trade in a way that what we used to might have come to the United States. You know, everybody's talking about, oh, well, we're pulling out of China and we're going to India and places like that and all. Understand that China's economy now is not just totally dependent on export. It has a lot of internal growth, but right now, some of that internal growth, which was based on real estate, is hurting. And it all depends on what decisions they may make, whether that turns into a fiasco or it bottoms out and gets better. And that's why I say I'm on the fence, because it can still go both ways right now.
Right. And yeah, you're quite right. China taking a big leadership position in politics recently brokered the resumption of diplomatic relations between Saudi Arabia and Iran. Two arch enemies now have diplomatic relations due to a deal brokered by China. So China certainly displaying a lot of leadership on the global stage, and arguably the US very much less so with the current administration. And that, in a way, brings us back to the dollar and the downgrade that we got from Fitch, keeping in mind that the US dollar is backed by the full faith in the US government. And when you start to lose faith in the US government, that can only mean losing faith in the dollar, and that can only mean a lower credit rating. And we got that credit rating downgrade from Fitch, AAA to AA+. The credit ratings agency said that the US fiscal deterioration and those very down to the wire debt ceiling negotiations were the reasons for the downgrade. But, arguably, there is more to this picture. We do know, of course, that not surprisingly, the White House strongly disagreed with this. U.S. Treasury Secretary Janet Yellen saying that there was arbitrary and based on outdated data, this downgrade. But what are your thoughts on what this downgrade really signals?
What I like to ask Ms. Yellen, the woman who said we'd never have a financial crisis again in her lifetime, I like to ask her, your Congressional Budget Office, the closest thing, if there is still, to something that's bipartisan, says that we're going to be at $50 trillion in hard debt in less than 10 years. That's where we're heading. So I would ask her then, since much of that debt that was done at lower rates is now going to be refinanced at higher rates, let's just say rates of 4 or 5%, and we have to finance that $50 trillion at 4 or 5%. We're going to be talking about half our entire income just to pay interest. That's a non-starter. And that's in 9 years or less. So I recently spoke to a bunch of young financial advisors who were all talking to me about crypto and all this stuff. And I said to them, I want to ask you a very basic dinosaur question from an old man. How do you take 50% of whatever you're making to pay interest? How do you live off the other 50%? And then I say to them, on top of that, 2/3 of Americans are working paycheck to paycheck and are never going to see retirement in the way that they would hope or been told that they would get to. What are those people going to do as they get older, and who are they going to look for help? So please explain to me within 5 to 10 years how the United States is going to be able to function as it used to function for its first 200 and something years. And, I get a couple of quick little responses and the subject is completely changed. But that's where we're heading. Now, I don't know if we're getting there in 5 years or 10 years or something miraculously happens, but we're going in a very bad direction. So unless there's dramatic changes, and I don't see it because, as I told you, politically, socially, and economically, I think we're in the worst era ever in America's history. I don't see how it can get better. So, yeah, can the markets go on for another year or two? Yeah, it's like that musical chair game we used to play. Yeah, eventually one person will get to sit in the chair, but the rest lose. And that's where I think is going to happen to a lot of investors if they don't start to understand how poorly this country is heading in all the things that matter, socially, politically, and economically. And Michelle, let me just say this to you. For someone that's in planning still, one time with athletes, but still work with the general public, this doesn't sell. This is not what people want to hear. So it's not a work benefit. And I don't have dry food or ammo or anything to sell anybody. But I can tell you this, after 40 years, I've never seen most people in the financial industry disregard so common, important fundamentals that we are facing right now.
Yeah, and those fundamentals, you just said it. I mean, crystallized by the government's own data. As you just pointed out, according to the Congressional Budget Office, which is an independent federal agency, U.S. government debt will rise from $32.5 trillion as of right now to $50 trillion, as you quite rightly said, by 2033. And breaking this data further, the Bank of America estimates that the U.S. government debt will be increasing by $5.2 billion daily for the next 10 years, daily. $5.2 billion daily when you work in all the interest on that. So you said there needs to be some kind of dramatic change. What could that dramatic change even look like at this point?
If you really want a true, honest answer, unless it's God inspired, I don't see how this country does it. I mean, we have two political parties now. In past financial crises, they managed to go in, maybe didn't do the best deal or the second best deal, but they managed to do something. I don't even think they could be in the same room with each other right now. And so the problem is going to be, as we move closer and closer to this horrific number, as things still get worse socially, politically, and economically, to expect political change to bring this to a better course, I think is impossible to look for. And that's why I say, and quite honestly, it doesn't feel good to say that either. It's not something I want to see happen so I can say, see, I told you so, because the amount of people that are going to be impacted by this and how lifestyle changes and all. But this is where we're heading. And we don't have any person or groups. There used to be in politics some people who were willing, the Ron Pauls of the world and all that. They're gone. Washington becomes so impossible place to bring change to legitimate good change. And that's why I say it's only a matter of time. It's not a question of if, but when these things really go from bad to worse.
Yeah, as you say, that is not the sentiment that sells. But what can an investor that is hearing this message, that is understanding what you're saying, that is looking at the data and the fundamentals do? What can one do to better prepare for this, at least from an economic perspective?
I'm glad you asked, Michelle. The first thing I tell everybody, which again, people don't like to hear, is less is more. We need to lessen our lifestyle. America, Wall Street and Madison Avenue convince people that more money equals more happiness. You can watch any financial ad. That's what it is. You come to us, we do these great things, and you live the way you want to live. The problem is we have too much stuff. How do I know we have too much stuff? Because 40 years ago, we didn't have a public storage facility every 2 miles on a major road, keeping stuff there that we can't keep in our 4,000 square foot homes. But the bottom line is less is more. And also understand this. Governments are going to have to tax more. So when you see the next election, whether it's local or state or federal, and they're telling you how they're going to lower taxes, just say, stop lying to me. You can't lower taxes. You're going to have to keep raising taxes because we keep spending money. It's hard for me, Michelle, to understand. When I entered the business, we were the world's largest credited nation. We now have multi-trillion-dollar budget deficits, not deficits, just yearly deficits. And the last group that met a few months ago, when they supposedly were going to fight the so-called debt ceiling limit, and why they call it that, I don't know, because they raise it every time. We've had almost $750 billion added in debt in just a few months. And there seems to be no responsibility for it. And no one seems to understand the ramifications from it for people that are in charge. So A, try to live less of a lifestyle. B, have as less debt as you can, because interest rates are going to remain high, especially if you're in more of a debtor. They're going to charge you even more money a premium if you're a large debtor. And understand that taxes are going to go up. And so if there's a way to lessen tax exposure. Now, I must tell you, and I love Kitco. I love it. I mean, there's no better place to hear about metals and all. But I don't own gold because I want to own it because the world's coming to an end. But I will tell you this. Central banks have been major buyers of gold for more than a reason of just being a trader or an investor. There's going to be some sort of change in the world where gold is going to play a role again. So if you don't own gold, that's one of the things that you should own.
Yeah, that is certainly a narrative that we have heard and discussed on Kitco many, many, many times. And that is that there will be some kind of reset that would involve gold, perhaps some kind of central bank digital currency with a commodity backing. That is potentially what the BRICS are working on. As we've said, that it's not going to likely come out from this meeting, but that is something that's been in the talks for a while. But also, to your point, we have had central banks making record purchases of gold, and that may indeed signal something. But beyond buying gold here, which, by the way, has not really been responsive to any of these news, and as you've said before, you don't actually really want the price of gold to soar, because that means that things in the world are going very, very badly and that it's an insurance play. But beyond gold, what do you think people should be doing?
Well, Wall Street treats metals in general as kryptonite. They are never going to come out and be a force to tell you to own large quantities of metals, because it flies in the face of what they do make their living off of: financial assets, stocks, and bonds. But there are a couple of things that I think seem to be heading in the right direction and can be profitable. The first one is uranium and things related to uranium. There is no way we are going to get anywhere close to the electrification that the world is speaking about with electric cars or whatever it may be, without nuclear energy being a major role in it. And the uniqueness about the uranium is there's not a lot of ways to play it. And therefore, people who want to have something that has fairly secure principal without much risk, but can still have some upside of substantial uranium, and the companies that own physical uranium are a worthy investment. I do think, even though it's still likely, as I said in a recent commentary of mine, that the rest of the year could be really hard for the metals and particularly the mining stocks, I do think once we get into 2024 and beyond, we're going to have a tremendous need for more copper. And the world, listen, there's one person that if you followed in these last 30 or 40 years, which I wish I followed more than I did, is Robert Friedland. Robert Friedland has been the head of the crowd for several decades. When Robert Friedland says we're going to have a huge problem with copper and copper supplies, I think people should listen. And it's true. And it's very difficult in mining now, Michelle. 30 years ago, you and I could have spun a globe, put our finger on a country and go, yeah, we can go there. That's not the case anymore. Mining companies are going to be very careful. They're seeing that where they're already at, countries are turning to them and making it very difficult, raising costs to work there prohibitively. And so they're not about to spend billions and billions of dollars in places where socially, politically, and economically it may be riskful. And we are going to be in real need of certain metals like copper in the next few years. So, yeah. Can it still trade lower, 25 cents or 50 cents? Yeah. Can it be back at $5 or $6 in 3 to 5 years? Most definitely, because that's the number that's going to be needed out there to drive these companies to spend billions of dollars to look for new copper supply.
Right. And you recently tweeted, I don't think we use the verb tweeted anymore. I believe we use the verb X. I'm not sure what we call it when somebody posts something on X now. Haven't quite figured out the verbiage there, Peter, but you posted on X that the United States Department of Energy recently added copper to its critical metals and minerals list. And you flagged that copper is now being seen as a national security issue. And you also pointed out that China is the top producer for 30 of the 50 minerals that the US Geological Survey categorizes as critical. So how does this then fit into all of those geopolitical tensions that you just discussed, as well as the idea of maybe China's economy slowing down?
And here we have a president who, for certain critical minerals that were in Minnesota where people thought they can find some, sorry, you can't do it. Now he just shut off uranium possibilities.
In Utah as well, yeah.
In Utah as well, at a time when the masses of necessary of metals that are going to be needed, even with names that I still can't pronounce, okay, but they still play a role in everything. And where are most of them? They're in areas of the world which aren't exactly friends or outright enemies. And so these are all things that, yeah, maybe for the next few months it doesn't impact us. But if you're looking out as an investor for the next several years, which we were called to do many years ago, there are so many issues to impact us. And again, copper and other types of metals are going to play that role as well.
So gold, copper, and uranium are your long-term plays here. What about silver?
Silver, the interesting thing, I used to get teased by silver investors because they always say, why do you always say it's the second best metal to own? Well, it didn't have the fundamental arguments that it has now. There's such been a dramatic increase in its industrial use that I think it can go neck to neck with gold right now. So I would equally own both of them now, and I would always own 2 to 3 times more gold than I would silver.
Okay. Do you have a long-term price forecast for silver, let's say a year's time and 5 years' time?
One thing I say about when people ask about prices, when I used to hear people say, hey, gold's going to 5 or 10,000. And my answer would be, is please, not for at least the next 20 years. And they go, why would you say that? Trust me, if gold is 5,000 in the next 12 months, what's happening in the world for us is not going to be a great thing. So forecasting numbers, I think what's important is that the trend should be higher. Both gold and silver have traded in a very unique once-in-a-lifetime technical pattern called the cup and handle, and it's been going on for a decade. And the handle's been being drawn out more. When they break to the upside, they go dramatically higher. Now, it can also break to the downside, and it would go a lot lower. But everything fundamentally otherwise suggests it should be to the upside. So when people say about price targets, I say a reasonable target to have is $30 for silver and $2,500 for gold. Those are at least areas where I'm personally believing they can minimally get to. And whether it's 6 months or 2 years, that's still an increase, which I don't think I'm going to see same type of return in equities, general equities.
Because you're expecting the market to drop dramatically. I mean,
well, I just think the market is not going to return It's not going to be the return machine everybody got used to. And there are people living beyond their means, Michelle. And once they recognize that the stock market is not the sure thing or the way to keep their lifestyle ahead of their earnings, that's when the markets will become much more tougher to deal with. And we'll actually have markets where they go down and stay down 10 or 20% from their highs, and maybe take 3, 5, 7 years to trade in a trading range. I'm still not in the camp of a crash. I've not been in that camp, but I'm also not in the camp of thinking that the market can get much higher than its most recent highs. I think it's just going to do what it did for almost 3 decades and trade in the trading range. People don't realize the Dow once traded between 700 and 1,000 for 30 years. Now I think we're going to get for many years, if not a decade or long, where it trades in a range, not yet totally defined, but probably something within 20% either way from here.
So, Peter, if gold and some of the metals do well in this environment where you see equities not doing well, does that apply to the miners, both the senior and the junior miners? What's your outlook there then?
Well, based on my latest broker statement, no, because I have losses now that I never imagined could occur in the mining share. So I may not be the best person to answer that question, but I'll try answering it anyway for you. We have either one or two things happening, particularly in the junior resource market. Either a bell was rung and that industry became the buggy whips and are no longer needed, and I didn't hear the bell and I'm going to be ever on the wrong side of the door, or we have a most compelling situation where right now you can just throw a dart at junior resource stocks and they're down anywhere from 50 to 90% from their high. Now, the negative on that, Michelle, is some of them are really on fumes now. They have too many shares outstanding. They have too few dollars in the bank. They're going to have to do something, either reconsolidate, reverse split, and or look to merge. But getting past that and getting past the next few months, I think a lot of babies have been thrown out with the bathwaters, particularly companies that already had advanced stage deposits, were already moving into potential production, but have now been priced with those other companies that are on fumes. That's why I think in the next few months, for people not yet fully invested or really have no exposure to that market, they have an opportunity not presented that I've ever seen in 40 years. Unfortunately for me, I jumped the gun and I'm almost fully invested with losses, but with companies I believe are in that group that I told you that are going to advance and eventually will get made whole and then some because of where the metal prices are going.
All right, so you're seeing a lot of value out there for people that have not jumped in to the miners. But as you said, it doesn't apply to you, but you're staying steady. You're certainly not going to realize those losses, and you're just going to continue to hold those positions waiting for that turnaround.
Again, it goes back to that principle I told you earlier. Could I first still buy these stocks today? And my answer is yes. That gives me reason to hold on. If I said to myself, oh boy, things change, I'd have to take the loss and go. But I don't believe that's what I'm doing.
Why wouldn't you get in now then? And at least that balances out your position if you bought some on the cheaper end.
Because for what I can commit to that group, I've committed most of it. Where the opportunity is for the people that are not yet fully invested or where most people don't have any exposure, this is a very unique time for them. Normally, I wouldn't have said in the last 40 years, hey, sir, sell your IBM, sell your treasury bond and buy a junior resource stock. That was not appropriate financial good advisory. But at this point, how inexpensive they are and relative to what returns could happen, it's a good time for people to speculate. And may I say, we came up with the word speculating on Wall Street, so we don't call it what it really is gambling. So if you can truly gamble, and when you gamble, you have to be prepared to lose part or all your investment. Those type of companies now, between now and the end of the year, when we look forward a year or two from now, we're going to go, boy, I wish I would have done this or that, what have you. I really believe that sincerely in my heart.
Okay, you've just maxed out your personal allocation to the miners, where you're saying you would advise your clients, and you are advising your clients to get out of other positions in other equities. In what? What are you saying get out of? Obviously, sell your BMW, but what are you saying get out of and get into juniors?
Well, I maximize what, if I want to stay married, what I could put in the junior resource stocks, Michelle. But what I would tell you this much is this, that I do think most people, the older you are, the less exposure you should have in general equities, particularly if you're hopeful that they're going to still give double-digit returns for you to keep your lifestyle going the way it is. You better look to cut your lifestyle then. I just don't think the stock market's going to be the money machine that it was for several decades. I do think bonds are a much lesser evil than general equities, but I think on the corporate side, especially REITs and anything exposed to commercial real estate, we have not yet begun to see the bottom in commercial real estate. It can still go a lot lower. So I think you have to be careful on your bond selection, but bonds in general have lesser of two evils of loss in principle to me than general equities right now.
Well, you're in good company. I know you like to be a contrarian, but your position regarding bonds has been echoed by Guggenheim Partners Investment Management, and they have more than $225 billion of assets under management. And they're saying that the place to hide out right now is in quality bonds. And they are seeing parts of the credit market on the lower side. They expect those to get hit, saying that they think that the market is not really pricing in the next shoe to drop, and that's credit. But the good place to hide out is high quality bonds. Let's go back finally to what you said about the miners. Do you have any particulars that you would select?
I had made it a habit, but because I really enjoyed this conversation, by the way, you really gave me a chance that I think that people need to hear. I'm not saying I'm going to be right, but I think it's a side of a voice that's not being heard that people need to hear. I do think there are some things that are going to happen in the mining. There has to be a dramatic now shopping list that the majors have. Things become, listen, there's a company called Northern Superior Resources. They're a sponsor to my blog, Disclosure, and I own the shares. But they have put together a bunch of projects in Quebec now that looks like it's at least up to 4 million ounces. And you can basically buy it at the current market cap at $10 an ounce. Every major knows that if it went out now to try to find similar type of grade and resource, they're going to spend anywhere from $50 to $70 an ounce. So that stock is likely a good takeover target or should see an increase when that market gets better. My largest holding, and it is by far my largest holding, is a company called Arizona Metals. And the reason I want to mention it is I don't want people just running out because some guy on a program said, go buy something. But where you look now for metals is going to be critical. They happen to be in Arizona. A premium is going to be paid by majors for projects in areas of the world where they don't have to worry about social, political, and economic changes for the worse. And Arizona and Nevada are the two best states to mine in the United States. And it's a company that has a phenomenal project, lots of upside potential, has been a baby thrown out with the bathwater, and something that offers, I think, a lot of upside potential. But again, only if you're suitable to be prepared to lose part of all your capital. I know it's hard to believe. It's very rare when you hear people that talk in the junior resource market, but people actually lose money in it. So this type of capital that needs to go into it needs to be like if you went off somewhere and spent it or went to a casino. And if you can, there's real opportunity in them now. Okay.
Those are your picks for the speculators / the gamblers out there. And you do see tremendous upside, particularly with potential consolidation in the sector, a lot of M&A activity expected. Peter, as we wrap up, any final thoughts?
Well, I have a motto now. It's something my father told me years and years ago. It had nothing to do with in the markets. But my motto is right now, as terms of investor, it's better to be a live chicken than a dead duck. So if Peter Grandich is wrong and things get better and debt crises go away and political things get better, you'll still be in a good position to take care of it. But if the Peter Grandiches in the world are right and you're on the other side of the coin, it's going to be a very big difficulty challenge.
Better to be a live chicken than a dead duck. Well, thank you so much for sharing that pearl of wisdom, as well as all of the other insights with us. Really appreciate it, Peter Grandich.
Thank you very much for having me again. Thank you.
We will have you on again very soon to discuss more on the political and socioeconomic fronts. But thank you. That's it for today. Peter Grandich, thank you so much. Of course, a big thanks to our sponsors, Meld. Now, Meld is a decentralized global bank providing cross-chain lending, borrowing, and staking. And it does let you unlock the value of your crypto without liquidating your position. And there is a special offer for Kitco viewers in the description below, so make sure to check it out. For me, Michelle Makori, and the rest of the team, thank you as always for watching, and we'll see you next time.
On the Spot with Michelle Makori is brought to you by Meld, the next-generation multi-chain crypto wallet that allows you to unlock the value of your crypto without liquidating your position. Undertake easy cross-chain transfers, yield, and borrowing by handling your crypto and fiat processes with transparency. Transfer fiat to and from crypto exchanges at low cost and in 15 currencies. Meld, your one account for money and crypto at your fingertips.